In this presentation, we will make loan payments. In other words, we will write checks related to loans that are outstanding. As we do so, we'll have to break out the interest and principal portion. To do that, we'll need to look at an amortization schedule, and we'll actually put together an amortization schedule so we can see how one would be put together. Here we are in our Get Great Guitar file. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown and selecting the Open Windows list. What we're going to do now is write checks for a loan that is outstanding. To consider this, let's first take a look at the financial statements. We're going to select the reports up top. We're going to go to the Company and Financial and be looking at the Balance Sheet Standard Report. Balance Sheet Standard Report, we're going to change the dates up top in the Customized Reports to 01/01/20 to 12/31/20 and January through December, and OK. So here is our balance sheet. We're going to be writing a check. We're going to be writing a check specifically related to the loans that are down below. So we have our loans down below here, $72,000. We're basically going to say, hey, this is one loan that we're going to have to be making payments for. Now, as we do that, when we make the payment, it's pretty straightforward what the payment amount will be typically. We know how much we're going to pay each month. However, what can be more confusing is the amount that should be broken out between interest and principal. So when we make the check, then we don't typically have just two accounts we have to write to. If we're going to do it properly, we've got to write a check and then break it out between the amount of principal, the amount that this number should go down by, and the interest that has accumulated. Now, there's a couple different ways that you can think about doing this. You may just want to say, hey, I'm just going to write it out to the principal only, and then let my possibly an accounting firm make a periodic adjustment, or we can make a periodic adjustment to it from time to time. That's one way that we can do it. In other words, I can just write the checks against this principal, and then at the end of the month, I can determine what the actual balance is, and then make an adjustment for the interest that's been recorded, or have my accountant help us with that on a periodic basis. That can actually work really well if you work with a CPA firm or accountant that wants to set up a system like that. If you want to break out the interest yourself, then of course you're going to have to need an amortization schedule. It's not just the same number each time, because of generally the setup of the way many loans will be set up. And oftentimes when you take out a loan, they give us the terms, the monthly payment, and the interest rate, but may not give us a full amortization table listing out the payments. And therefore, we can't really break out the principal and interest until we actually create one. So we'll create one here just to show you how to put one together, and what would be needed and how it would be scaled and put together in order to basically break out the interest payments. Why do we need one? Because the interest payments will not be equal throughout the term of the loan. So let's just consider that now. We'll take a look at an amortization schedule. Will look something like this. We're going to say we have a loan of $72,000. Now we're going to say that we pay monthly on the loan. So we pay monthly on the loan, and then we have the interest rate is going to be 5%. Normally they say the payment's going to be fixed so that we know how much we're going to pay each month. However, given that fact, because we're going to have a fixed payment, that means that the amount of the amount that's going to be interest and principal is going to differ each month, because what's happening is every time we make a payment out of the principal goes down, and the amount of interest on it will then be reduced. So if the payment remains the same, which is nice, what we kind of want to have, we're not going to have an interest and principal that's going to be the same. So we have to make an amortization schedule which looks something like this: same payment. However, of that payment, 300 of it is interest, and this is the amount of the principal reduction. And then the second payment goes in a similar fashion, and so on and so forth. So let's think about how we would make a table. We'll put together a table just to do it. You could get help with basically putting a table together. Just depends on the terms of the loan. And then once you have the table, you can use this then to create the journal entries, as we'll do, to write the checks and properly allocate between the principal and interest. So I'm going to we're going to say that we have a $72,000 loan. That's in the loan statement. We know it's a 60 period. 60 period means 5 years. 5 years times 12 months. We're going to pay it on a monthly basis. And let's say we have the interest rate, and let's just figure out the payment. We're just going to use Excel to figure out the payment amount this time, just to show you that if you have the data, you can then figure out the payment method. or what the payment will be, and then you could use that to make the amortization schedule. They probably give you the payment. Sometimes they actually don't give you the rate and something like that. So let me just show you the two methods we can have to figure out the missing number. So if we had all the information and we needed to figure out what the payment would be if we had to pay $72,000 loan every period, for 60 periods and 5% interest, then we would say, okay, we want to go to the formula tabs up top. I'm going to go to the insert function. This is going to be and I'm going to call this and search for the PMT, which is the payment function. And so the PMT payment function, we're going to say okay. And then it's going to give us our little dialog box that we can fill in. Now to fill this in, it says the rate first. I'm actually going to point to the rate. The rate says 5% here. I'm going to say 5%. Now that's for a year though, because whenever we hear the rate, it's for a year. And we're actually breaking this down into monthly periods. Therefore, I'm going to take that and I'm going to divide it by 12. That's the trickiest component to this. And then we're going to say the number of periods. That's going to be the 60. Number of periods will be the 60. Then we'll say the present value, which is today's value, the actual loan amount, which is the 72,000. Pick up the 72. We don't need the future value or the type. You can see it already gives us the answer here of the 1358. It's not rounded, so there are pennies involved. We're going to say okay, and there it is. Now, if I was to double click on this, I'm going to put a negative in front of it to flip the sign because I like to see it with a positive number. So I'm just going to put a negative in front of it, and there it is. Now, the other way you could do that, you could actually type this formula in, type in equals payment, and then it gives you this little dialog box. So down below it says that's the rate. The rate's in B3, which is this one, divided by 12. And then this, it says, is the number of payments. The number of payments in B2. And then this is going to be the present value. Now, if you don't want to learn the Excel or this is too much, then just bear with me. We'll just use this to create the table. But this can be useful to basically have and understand the payments. Now, what if they gave you these numbers, but they didn't give you this number, right? What I would do then is basically guess this number, right? I'd say, well, what if it was 8%? Then put this formula in place, knowing that this has a problem, and because I know what the payment is, it's wrong, right? So now I have a payment. I know the payment is 1,358 something, and if I use this number in this formula, I get to this number, and then I can change the rate until I get the right number, or I can let Excel do that. So I can then use the data tab up top, and we can use this tool, which is pretty nice in a formula, which is called the what if analysis, and then we could goal seek. And then so what we're going to do is just say, okay, I want to change this number to what it needs to be. So I want to set this cell, I want to set this cell to be what I know it should be, and we know that it should be about, let's say 1359. And then I'm going to change, and it's rounded, so I'm estimating there, so it's going to be a little bit off. And then I want to change basically this number. So I'm telling the Excel to say, hey, I want to set this cell to be what I know it is because they gave me what the payment was 1359 by changing this number, the rate. So make the rate whatever you need to do to make this work. So we're going to say, okay, and then it changes the rate to that 5%, right? So we're going to say, okay. And there we have it. So if you don't have any of these formulas, I would figure this formula out and then think about what the percent would be given that. Now I'm going to change this back to just a flat 5, and then there we have that. Now this actual amount is rounded, so it's really something a little slightly different. Keep that in mind as we go through. Now we're going to do the same thing in terms of the payments down here because this isn't enough information for us to actually write the check because it doesn't tell us payment by payment how much we should break out. So we'll make the amortization schedule. So within payment 1, I'm just going to type in 1. Let's start at 0, 0, 1, 2. That's a series. Excel can then populate that series. It's going to guess the next one is 3 and so on. So I'm going to put my cursor on the autofill and then autofill it down and see how it gives you that little number to the right. I want to go down till it's 60. This looks like a long process, but it's actually fairly quick with Excel. So we can put this together pretty quickly. Goes down to 60. Then the payment amount is going to be equal to, actually we're not going to have a payment at 0. Let's put the principal, I think This should be principal, I think it is. I always get that mixed up, but in any case, we're going to say the principal is the 72,000, and then that's what it's going to be at payment 0 time. And then we're going to make a payment of 1,359. 1,359. How much of it will be interest? Well, the interest portion is going to be the 72,000 times 5%, 0.05. That would be for a year divided by 12, 300. So let's do that here. It should be equal to this times the 5% divided by 12. And that means the principal reduction is going to be the amount of the payment minus the interest. And that means that the new principal, as of after payment 1, is going to be the 72,000 minus the 1,059. And so the problem is that, so that means that the first paycheck, the first time we make a payment, we'll pay the 1,558. However, we'll have to break out the other side. Cash will be going down by that amount, but the other side will have to go to interest expense and reduction in principal, these two accounts. And then if we go to the second one, it's going to differ now. If we go to the payment 2, it's going to be the same payment amount, but now the interest will be calculated not at the 72,000, but at the 70941 times 0.05. That would be for a year divided by 12 for the month. So it's slightly different, and this will be significant over time. So the second one is going to be equal to this number times the 5% divided by 12. And if we then have the amount of the principal reduction, will be that. So now of the same amount of payment, the interest is slightly different portion of it, and then the principal is slightly different, right? It's going to go down on interest because there's less rent on the money because we have less money that we rented. Therefore, the interest portion will go down, the principal portion will go up, payment remains the same. This is the cost to us of making the loan formatted in such a way that the payment remains the same. The principal and interest then vary. And so then we're going to say, all right, so now we got the 70,941 minus the 1,663, and that's our new principal. And we could do this again and again, so on and so forth. I'm going to then copy this down and see if it does what we would expect it to do, and see if we could just simply autofill this down now. I'm going to put my cursor, I'm going to select this row, put my cursor on this autofill, copy it down, and notice there's a problem here. What happened? It pulled that 5% down. We don't want it to pull it down. Everything else is fine. Therefore, I have to absolute reference that 5%. So I'm going to do that now. I'm going to undo. This one, if I double click on it, this one in B3, is it B3? Yeah, I don't want that one to move down. So what we do is make that an absolute reference. The way we do that is you put a $sign before the B and a $sign before the 3, or you can push F4, which will do it for you. So a $sign before the B, a $sign before the 3. There we have it. You really only need a mixed reference, but an absolute reference will work. And then we're going to say enter. Then if we select this and then autofill it down, I pulled it down. I want to autofill it down. Autofill it down. Then it looks like it's doing what we want, right? That one's coming from above. That one looks like it's doing what we want. And there we have it. So I'll just populate this all the way down. I'm going to select this whole thing and populate it all the way down to the 60. And so if we populate it all the way down, it should come to 0 in this bottom cell here. And so that means that it looks like it's done properly. So because it came to 0. So that's what we need. We need a schedule like this to break out the interest and principal. So whenever we make a payment, we can do that. There are various tools you can use online. It doesn't take too much time actually to do this in Excel if you've done it a few times. So now let's record the payment. We're going to record this first payment here. This is the payment amount. Then we're going to break it out between interest and principal. We're going to record the one at the beginning of the month and then at the end of the month so that we have two payments and you can see the difference between them as we write the checks. Now we're going to go back to QuickBooks. The first time we're going to enter this, we're going to write a check. But this time, instead of going to the Home tab and the Write Check, let's go to the Register because we have two accounts that are going to be affected. And this is the first time we get to see kind of a split type of screen that we might see like 3 accounts affected in the Register. Can you do that? Yes, you can. So let's go to the Reports. Let's go to the Banking drop down. we're going to go to the use register. Then we want to be within the checking account. We'll select OK. And we will put this in as of 02/01/20. So first day of February, the check number should populate well. So that's it. We're paying Chase. So Chase is the bank where we had the loan. And it's going to be a payment. We're going to make the payment for the amount on the amortization schedule. That's the easy part. We know what that is. That's still going to be the $1,359. Remember, this is rounded. So I'm going to just round it here and use whole numbers. So we're going to say, all right, we're going to make the payment for 1359. And then the confusing part, we're like, well, now we need the other account, but there's only one cell. Like there's only one place to put the other account. And we're going to need two places because we got to break it out or allocate between interest and principal. So what do? We use the trusty split thing down here, split item. So we go to the split item, and then we can break out between interest expense and principal. So interest then, the amount of interest, if we select the drop down, which then is a rise up, we look at the interest expense, see if we have an interest expense. You would think we would. There it is. There it is. I was getting doubtful. And then we're going to say the interest portion is $300. Remember, the interest is like the rent on the money. It's just like we rented money and we had to pay rent on it. That's the interest. It just goes away just like if you rented a house. It is what it is. So we're going to say that's going to be the $300. And you could put a memo that, first payment on note or something like that. And you might want to actually copy that and put the memo on the second tab as well. And the second is going to be the reduction in the loan amount. So the loan is on the books as a liability. So if you go up to the liability up top, here's the loan payable. Selecting the loan payable, it will then populate the amount for you. Let's double check that it is correct. I just copied and pasted that memo. 1,059. So back over here, 1,059. Looks good. If everything works properly, the loan balance should go down to $70,941. It might be $1 off for rounding or something. So we're going to say, okay, and let's record it, see what happens. There it is there. Let's check out our reports, balance sheet first. Within the balance sheet, we wrote a check, double-clicking the check. Scrolling down, there's our check. Double-clicking the check. We see the detail. Here's the two accounts down below in check format. Closing this back out. Closing this back out, the other side, one part of the other side going to the payable. So here's, that's not it. That's not the one. Here's the loan payable. Now it's at $70,941. Does that tie out to our amortization schedule? It does. $70,941 looks proper. Let's go into it, see what happened with it. Double clicking on it. And there we have it. So there's the 72 that we were at this point. There's the payment. Notice it's only for the amount that we allocated to the principal. Double clicking on it, we can see that here. The other side's going to interest. Closing this out, closing this out. That'll be on the P&L, profit and loss. Reports up top, company and financial, and profit and loss report. Dates then 01/01/20 to 12/31/20. And there is our profit and loss. There's our interest expense, double clicking on that. There is our check, double clicking on that. There's our check. Closing this back out, closing this back out. You can find this probably more easily if you go to the trial balance. Let's just take a look at that. Reports. If we go down to the accounting and taxes trial balance, take a look at that report. We're going to say 01/01/20 to 12/31/20. Then you can see a little bit more cleanly. Here's the checking account. And then we had the loan, which is going to be a liability account here. And then you could go into the expense for the interest all in one place. Now we're going to do this again. So I'm going to close this check, the check register. I'm going to close this out because this time we're going to go into the home tab and actually write a check, which we could do here, or we could do from the banking drop down and go to the checks. Same thing now with the second payment. Now we're going to jump forward in time. So we're going to say this was a month later, but we're going to do it basically at the end of the month. Why? Because we want to record two checks right now so you can see the comparison between the two. So we're imagining a month time has passed and we're going to record the second check at the end of the month. This will kind of confuse things a little bit as we go, a little more or less chronologically through month 2 here, but we think it's worth it to put the two things together at this point in time. So now we're imagining end of the month. Now we're going to record the second check. Notice what's happening here. It's going to be the same dollar amount. However, interest and principal will differ. This is where we should end at the end of this one. So let's do this. We're going to say now in check format. It's going to be out of the checking account, of course. Check number looks good. We're going to say this one is as of the end of the month, 02/28/20. We're going to say it's going to be paid once again to Chase. And then we're going to populate this with the 1359. And there we have Chase looks good. And we could put that this is going to be, well, let's just keep it blank. We could put second payment on the loan or something like that. We're just going to put the amounts here. It's going to be the interest expense. I'm typing it in there. There it is. What amount is it? However, it's going to be for the 296. Again, it's rounded. I'm just going to have no pennies, 296. So it's going to be 296. And then the principal portion, notice it calculates it for us. We're going to put in place at the loan payable. Loan payable. Principal portion, the 1,063 looks good. That should leave us with a loan balance of 69,878 after we have recorded it. So going back down, that looks good. We're going to say save and close. There we have it. And then if we go and review this in the balance sheet, we're going to say that the balance sheet now up top, if we go into the checking account, is at the 91,718. Double clicking on it, there's the second check as of the end of the month. So here, and there, obviously the checks in here are the same amount. Closing this back out, however, they will be different in the loan amount. So here's the loan amount. That's at 69,878. That should match what's on the amortization schedule. 69,878 looks good. Going into it, double clicking on it, we're going to see the detail, hopefully. And there's the detail. And of course, it differs here between the two, first and second. If I double click on this, there's our check with the allocation. Closing this back out and closing this back out, then we can go to the profit and loss report. And in the open windows, here's our interest expense. Double clicking on it, you'll see the difference between the interest expense from the first payment and the second payment here. Closing this back out, you can also, of course, see this information possibly more clearly on the trial balance where you have the checking account. You've got the loan payable and you have the interest expense down below.